Something changed about taxable brokerage accounts that almost nobody talks about. A few years ago, the strategy I'm about to show you was only available to institutional investors, hedge funds, university endowments, family offices with $10 million minimums. Today, it's available to anyone with a few $1,000s in a brokerage account. At $3 million or more, it's the difference between the brokerage account being your best account and your worst account. It can also reduce your taxable gains by $15,000 to $40,000 a year, forever, and it's a key pillar to any retirement plan. For most of the last 40 years, the retirement planning hierarchy went the same way. Max your 401k, then max your Roth, then think about your brokerage account. The brokerage was the leftover bucket. The hierarchy was right when it was taught. It stopped being correct around 2020, and for households with over $3 million, it's flat out costly. The brokerage account isn't the leftover bucket anymore. It's the only account in your portfolio that can offset realized gains with realized losses every year you hold it. The only account with no required minimum distributions, the only account that, when properly structured, does not cause future IRMA problems, and the only account that gets a complete tax reset when you pass it to your heirs. In the next 15 minutes, I'll show you the specific change that turned it from a passive holding account into what I call the harvesting engine, and the 3-question filter that tells you whether running this strategy is worth doing for your portfolio. And be sure to stay to the end when I go over how the strategy we are talking about today has evolved over time to create even greater tax outcomes for clients. If you have a brokerage account or are planning to start contributing to a brokerage account, this video is for you. The strategy is designed to work really well for investors with a few $100,000 or for those who plan on building an account to that level or more. At $1 million in brokerage, this strategy might capture $30,000 a year in losses. At $500,000, closer to $15,000. But what those losses are really doing is offsetting gains realized elsewhere. A year where you can harvest $30,000 of losses allows you to offset gains on other positions with no tax implications. Run that playbook every year for the rest of your life. Above $3 million in total assets with $500,000 or more in brokerage, this is table stakes. It's the difference between paying tax on every dollar of capital gains you have and having a strategy that methodically reduces that number over time. I'm Ryan Knoll, founder of NavWealth Partners. We specialize in helping retirees with $2 to $5 million or more pay fewer taxes in retirement. In the last 2 years, my team has implemented this strategy for dozens of households. The typical household at this asset level generates $15,000 to $40,000 in harvestable losses every year. Losses that offset capital gains, reduce taxable income, and compound the value of every other piece of the retirement income plan. Let me show you what changed, what the strategy actually is, and the 3-question filter that tells you whether it's right for your portfolio. For most of the last 40 years, the retirement planning industry built its account hierarchy around one rule: tax-deferred accounts first, Roth accounts second, taxable last. That answer was mainly right through the 1980s, the 1990s, and most of the 2010s. It stopped being right for $3 million households around 2020. Here's what changed. For decades, the brokerage account had 2 tax features: long-term capital gains at preferential rates and step-up in basis at death. Both passive, the 401k had pre-tax contributions, tax-deferred growth, and employer matches. The Roth had tax-free growth, tax-free withdrawals, and no required distributions during your lifetime. So the hierarchy made sense. Accounts with more tax features came first. The account with only 2 features went last. And around 2020, something happened that the hierarchy never adjusted for: a strategy called direct indexing, which frankly had existed since the 1990s for institutional investors at $1 million minimums. And it became available to individual investors at $250,000 minimums or lower. The math that justified the strategy had been true for decades. The access to it, though, was new. And direct indexing did something the brokerage account had never been able to do before. It turned the account from a passive holding into a tax-advantaged engine. Suddenly, the brokerage had a third feature, the most valuable feature of any account at the $3 million or more level: the ability to offset taxable gains every year you hold it, instead of just preserving wealth and waiting for the step up at your death. At $3 million in total assets with $500,000 in brokerage, the account that reduces your capital gains by $15,000 to $40,000 a year while still maintaining full market exposure is no longer the leftover bucket. That's the engine. The math hadn't changed, the access had, but the hierarchy you've been operating under was finalized before the access opened. And nobody updates the advice as fast as the tools update themselves. Direct indexing in plain language now. Instead of buying the S&P 500 index fund, you buy the underlying 500 stocks directly inside a separately managed account that tracks the index automatically. The platform handles every transaction. You don't pick stocks or rebalance. So far, this sounds like an expensive way to do what an index fund already does. If all the strategy did was replicate the index, that would be true. Here's what it actually does. In any given year, even when the S&P 500 is up something like 20%, nearly a third of the underlying individual stocks can be down. That's the nature of an index. Apple and Nvidia and Microsoft carry the whole thing, while a third of the constituents quietly lose money. When you own the index through an ETF, that internal volatility is invisible. You don't get to capture it. The ETF shows one position with one performance number. There's nothing to harvest because the ETF is, for tax purposes, one stock. When you own the index directly, every one of those 500 stocks shows up on your tax statement separately. The platform monitors all of them. When any individual stock drops below your cost basis by a meaningful amount, the platform sells the position, books the loss, and immediately buys a similar stock to maintain index exposure without violating the wash sale rule. You end the year with the same market exposure you would have had inside the ETF, but you also end the year with realized losses on your tax return. Losses you can use against capital gains anywhere in your portfolio, against ordinary income up to $3,000 a year, or carried forward indefinitely. That's the engine. The portfolio still tracks the market. The losses are real even when the index is up. You harvest individual losses without sacrificing aggregate performance. This wasn't possible at non-institutional scale until 5 years ago. Now it is. And you're not just limited to the S&P 500. You can follow different indices like the Russell 2000, some international indices, and the NASDAQ, which allows you to build a very robust, well-diversified portfolio just as you would with index funds. But you're doing it with individual stocks. Let me show you what this looks like for the type of client we see most often. A typical household at this asset level, 62 years old, married, 3 years until retirement, $3.2 million in total assets, 2.1 of which is in their traditional IRA, 700,000 in their taxable brokerage account, and it holds 2 or 3 different index ETFs, and then they have $400,000 in a Roth. They follow the standard hierarchy their whole working life. They maxed the tax advantage accounts and treated the brokerage as a leftover bucket. When they came into model retirement income, the gap was obvious. They were planning 8 to 10 years of Roth conversions to fill the 22% bracket, which is significant ordinary income every year, with no strategy to offset any of it. They had $180,000 of gains sitting in the brokerage doing no work for them, and they had no annual tax shelter beyond the standard deduction. So we restructured. One of their ETFs, which was worth about $100,000, was down $20,000, so we harvested that and reinvested the position into a direct index. From the positions that were up, we realized $20,000 in gains, completely offset by that loss we sold previously, and freed up an additional $50,000 of capital. At this point, they had $150,000 in a direct index and $550,000 left in the remaining ETF with $160,000 worth of embedded gains. They also had been funding $50,000 into their brokerage account every year. We redirected that to their direct index. By the end of year 1, we had invested $200,000 in the direct index and it grew to about $215,000. We harvested $10,000 of losses and offset $10,000 of gains from the ETF. Those $10,000 of gains that were realized reduced the ETF by another $35,000, which we then added to the direct index. So at the end of year 1, we had $250,000 in the direct index itself. Starting year 2, after another $50,000 contribution, we started the year with $300,000 in the direct index and followed that strategy for all of year 2 and then all of year 3 as well. At 65, when they retired, the brokerage portfolio was worth $1 million, $450,000 in the ETF with unrealized gains of about $100,000, and another $550,000 in the direct index with $10,000 of gains. So their overall gain exposure was reduced by $70,000. They were still generating losses. When it's time to pay tax on each conversion, they sell appreciated positions to raise the cash, and the harvested losses will offset those gains. So funding the conversion costs them absolutely nothing in tax. If there's money left at that point, that is then reinvested back into the portfolio. In the 3 years before retirement, their gain exposure dropped by $70,000. And across the first 8 years of Roth conversions, the strategy let them offset roughly $120,000 of realized gains in total. Gains they would have otherwise had to pay tax on fund the conversions. At 15% plus 3.8% net investment income tax, that's just shy of $23,000 in tax they never paid. These tax savings allowed them to put a down payment on a new boat to enjoy their summers on Lake Erie. Now, I'll be honest with you, the reason most advisors aren't running this strategy isn't that they're bad at their jobs. It's that they were trained before this tool existed. Direct indexing was institutional only when most CFPs got their certifications. The exam questions were about ETFs because ETFs were the right answer at the time for individual investors. They still mostly are for accounts under $250,000 at $3 million in total assets with $500,000 in brokerage. That right answer, those changed. Most of the prospective clients who come into my practice already have advisors who are competent professionals, but they're using an account hierarchy that was finalized before one of the most important tax tools available to households at this asset level became accessible. That's what frustrates me about how this industry handles households with $3 million or more. The playbook updates slower than the toolkit. The advice you got 5 years ago might have been excellent advice 5 years ago. It's not necessarily excellent advice right now, and nobody calls to revisit it when the landscape changes. You deserve advice that's current. Let me show you the 3-question filter that tells you whether direct indexing is worth implementing for your portfolio specifically. Here are the 3 questions that tell you whether the harvesting engine is worth running for your specific situation. Question 1. Is your taxable brokerage account projected to grow to at least $250,000? This is the floor. Below $250,000, the harvested losses don't generate enough tax savings to justify the management complexity and platform costs. The strategy works at $250,000. It works better at $500,000, and it works even better at $1 million and up. Below $250,000, you might want to consider holding standard ETFs and revisit when the account grows. For most $3 million plus households I review, the brokerage account sits somewhere between $400,000 and $1.2 million. Almost all of them clear that floor easily. Question 2. Do you have unrealized gains elsewhere or planned realization events in the next 10 years? The harvested losses need somewhere to go. If you have unrealized capital gains in the brokerage you'd like to diversify out of without paying tax, direct indexing supplies the offsetting losses. If you're planning Roth conversions, direct indexing offsets the conversion income. If you have concentrated stock from a previous employer that you've been afraid to sell because of the tax bill, direct indexing makes selling cheaper. If you have no gains and no planned conversions, the losses still have value, up to $3,000 a year against ordinary income, with the rest carrying forward indefinitely. But the strategy hits its highest value when harvested losses get used immediately against planned realization events. For $3 million households doing Roth conversions, the answer to question 2 is essentially always yes. Question 3. Is most of your brokerage intended to pass to heirs at step up, or do you plan to liquidate large positions during your lifetime? This is the closer question. Direct indexing creates a slow drift downward in your cost basis over 10 to 20 years. If you plan to liquidate the account during your lifetime, that lower basis means more tax owed at liquidation. But if your plan is to hold most of the account until death, the cost basis resets at step up. Every dollar of basis drift gets wiped out at that moment. The annual tax savings you captured along the way are still captured. The strategy hits its full economic value in this instance. For most households I work with, the brokerage is the inheritance account or the late life backstop. Step up resolves the cost basis question. The strategy works. If all 3 answers are yes, your account is at least $250,000, you have gains to offset or income to harvest against, and most of the account will hit the step up, direct indexing belongs in the strategy. If any of the 3 is no, the math is closer, and it may not be worth implementing. If you want to see how this fits into the bigger picture, how harvested losses interact with your Roth conversions, your Social Security timing, and your IRMA, I put together a free retirement income architecture blueprint. The harvesting engine is one of the sections in it. Links in the description. It'll walk you through your own situation step by step. And if you'd rather we model it for you, your actual projected annual harvest mapped against your conversion plan, there's a link to book time with my team right now below it. Now I know what you're thinking. You need to switch to a direct indexing strategy right now. And this could be the right call for you. But since direct indexing has become more mainstream, it has continued to evolve. Now there are more indices that are tracked. You can run the strategies with not only stocks, but also ETFs and other funds. And some asset managers even implement a long-short strategy where you can harvest losses on your long positions that go down in value and your short positions that go up. All this means is you need to know exactly what type of strategy works in different situations. If you are still building your direct indexing strategy, it likely makes sense to use an individual stock or ETF portfolio. This is a well-diversified strategy that should perform in line with whatever index it is tracking and give you more tax advantages changes over time. However, if you need to generate massive amounts of losses, maintain performance somewhat in line with the underlying index, and do it all over a short period of time, a long-short strategy may make sense. Take, for example, a business owner who wants to sell her business. Her cost basis is $500,000, and she's going to sell this business for $4 million. Absent any deal structuring, this will have her pay taxes on roughly $3.5 million worth of gains, and she will likely be taxed at 20% capital gains tax rates and 3.8% net investment income tax rate on all of that. That's roughly $833,000 in taxes owed in this sale. But let's say she sells her business on the first day of the year and does not owe taxes on it until the end of the year. She might want to set aside something like $1 million and leave it in cash to help pay for a big chunk of those taxes and to replenish her spending cash. Then she might want to take $1.5 million to put in a traditional direct index. That could generate somewhere between $50,000 and $100,000 in losses depending on performance. Let's assume it hits the midpoint and generates $75,000 of losses over that first year, and that investment grows by 10% and is now worth $1.65 million. The remainder she could put into something like a 140-40 long-short model. That means she is long on 140% of her portfolio and short on 40% of it. This amplifies losses because she could book losses as long as the market moves up or down. Let's say she's able to generate losses on 13% of her initial contribution, which is reasonable for first-year average performance in this type of model, and this would book her something like $195,000 in losses. This portfolio does not grow by as much, but still earns her a healthy 7% rate of return and is now worth $1.6 million. So over the first year, she booked $270,000 in total losses and lowered her tax burden on her business sale by $64,000. And her total portfolio balance grew to $4.25 million by the end of the year. Now, you're probably wondering why we would not allocate everything to the long-short model if it generates losses at a greater rate. And while that is true, there are some big risks you need to be aware of with long-short models. First is fees. There's a reason her long-short index returned less than the more traditional approach. It's more expensive. A classic direct indexing model can be run for around 10 basis points or 0.1%. A long short is typically a minimum fee of 1% and has financing costs on the short side of the portfolio of 0.5% to 1% on top of that. There's also unlimited downside on the short positions. If you short a stock and it goes up, you lose money. In a world where this happens with multiple short positions, you could lose a huge portion of your portfolio. Yes, you're going to be able to collect those losses, but at a certain point, excess losses are catastrophic to the overall portfolio and you lose money. Finally, the use of leverage amplifies returns. This can be a really good thing when markets churn higher, but it can be a really bad thing when they trend lower. Gains are amplified by leverage, but losses are too. This is why using a long-short strategy should not be the only strategy, but rather part of a larger cohesive plan. And ideally, it is not used for long periods of time where excess manager fees and financing costs eat into your returns so much that the tax savings end up not mattering at all. Now, I do want to put one small disclaimer in here regarding the strategy too. It needs to make sense for you and your goals. These are very nuanced investments that do not make sense in every situation, so please fully vet the strategy yourself or with your planner to see if it makes sense for your unique situation. In closing, the brokerage account isn't the worst account in your portfolio. It's the only account where realized losses offset realized gains tax-free every year you hold it. The only account without required minimum distributions other than your Roth, and the only account that gets a complete tax reset at death. And now, for the last 5 years, the only account that can turn market volatility into harvested losses that offset gains elsewhere in your portfolio. The hierarchy you've been operating under, max the 401k, then your Roth, then think about the brokerage was right when it was taught. It stopped being right around 2020 for households at your asset level when this strategy became available. The advisor who gave it to you wasn't wrong. They were using a playbook finalized before the tool existed for you. The math has changed, the advice mostly hasn't. You're wealthy enough that your brokerage account can reduce your taxable gains by $15,000 to $40,000 a year, every single year for the next decade, if it's structured correctly. Not wealthy enough to leave that on the table by holding standard ETFs, because that's what every retirement book recommended in 1995. The 3 questions take 5 minutes. Run them this week. If your brokerage account is at least $250,000, if you have gains to offset or conversions to run, and if most of the account is heading towards step up, direct indexing belongs in your plan. If you'd like to model your specific situation, what your projected annual harvest would look like, how it interacts with your Roth conversion strategy, there's a link to my calendar in the description. My team implements this strategy in-house for clients. If it fits your situation, we'll show you what the projected harvest looks like for your specific portfolio. If it doesn't, you'll leave the call with confidence that your current brokerage strategy is correct. The brokerage account most $3 million plus retirees were told was their worst account is actually their best, but only if you stop treating it like the leftover bucket and start treating it like the engine. Make smart money decisions, and I'll see you next week.